In this video, we will talk about the meaning of interest rates. Interest rates are among the most watched variables, and there are people every day who are anxious about the trends in interest rates. Some people want the interest rates to increase, some of them want them to decrease, and this is simply because the interest rates have a very big impact on the decisions. Interest rates impact individuals, businesses, and the level of interest rates actually even cause the government to take actions. At the individual level, the interest rate can make you decide whether to buy a house or not, consume more or save more. At a corporate level, a business may decide to invest in a new capital equipment or not, depending on the level of interest rate, or acquire a loan to expand business or not. Okay. So the level of interest rate, too high or too low, may also call for some institutional actions in order to address specific economic situations. So, based on these few examples I just gave you, we can already see that interest rates are really important. And because they are important, we need to understand the relationship that they have with the economy as a whole. And this is the goal of this chapter. Before we dig deep into the concept of interest rates, we need to understand a very important concept called the time value of money. So, this concept is based on the observation that time has an impact on the real value of money. What we mean by the real value of money is simply the purchasing power of money, what money can buy. This is different from the nominal value of money, which is just the digits or the numbers on a paper bill or a coin. So if you have $100 bill, for example, $100 is the nominal value, but this doesn't tell you how much this can buy. Okay, so $1 today is worth more than $1 in the future. Okay, that's really because of the impact that time has on money. For example, according to the Census Bureau, the median annual household income in the USA was $687 in 1915. In other words, in 1915, an American household could afford the basic necessities of life with only about $700. Today, this amount is above $59,000 on average. Okay, simply because the value of money was higher, the value of the US dollar was higher in 1915 than it is today. Alright, so the time value of money actually explains why interests are paid whenever loans are taken. For example, let's assume that you take a loan from a bank, a loan of $1,000, and let's assume that 1 year from the time you take the loan, you refund $1,000. If we take the time value of money into consideration, this is a loss for the bank because the $1,000 that you borrowed last year, had a higher value than the $1,000 that you are refunding today. So interest rates can be seen as an acknowledgement that the value of the original amount that was borrowed, that we also call the principal, decreases over time. So you pay a little extra. Well, not necessarily a little, but you pay extra in order to make up for this loss in value in the principal. And this is the reason why interest rates are also called the cost of borrowing, when it comes to loans. Okay, now that we understand the time value of money and we have an idea of what interest rates are, the extra you pay to make up for the loss of value of money over time, let us talk about cash flows, the concept of future value, and the concept of present value. Well, if you're trying to invest in a project, or if you want to invest in a debt instrument like a coupon bond, and we'll talk more about coupon bonds soon. Well, this investment will definitely involve a stream of cash receipts and cash payments. Cash receipts are also known as cash inflows, like revenues and profits. Cash payments are cash outflows, like the purchase of equipment and various expenses. And these cash flows occur over time, okay? And this is why the concept of the time value of money has to be taken into account when analyzing them, okay? When analyzing the cash flows. Let's use an example. Let's assume that your company is trying to decide whether to embark on a 4-year project or not. Okay, so the financial experts of your company forecast the different cash flows of the project. The first cash flow is the initial investment of $10,000 to start the project. Then 1 year after that, well, there's going to be another cash outflow of $2,000. In the second year, one cash inflow of $4,000. In the third year, one cash inflow of $7,000. And in the last year, which is the fourth year, we have another cash inflow of $3,000. Okay. So we want to determine whether this project is viable or not. And the process of determining whether a project is viable or not is known as a feasibility study. So we want to conduct the feasibility study for this project. So someone may say, okay, let us look at all the cash outflows. $10,000 plus $2,000, that's a $12,000 investment in the project. And let's now look at all the cash inflows. So this is how much money we're going to make. 4,000 plus 7,000 plus 3,000, and that's 14,000. Okay, and that person may say, well, since we are making, or we will be making more money than we will be spending in this project, okay, we'll have a net profit of $2,000. The conclusion is that this is a viable project. We should go ahead and embark on it. But this analysis actually is wrong. The reason why the analysis is wrong is simply because it does not account for the time value of money. See, these are all the cash flows involved in the project. So minus because these are cash outflows, and these values here are positive because they are cash inflows. We receive the money. So we can't just subtract and add these amounts, because some of them are in the future. And because they are in the future, time is going to have an impact on them, especially these cash flows from year 1 to year 4. This is considered as a cash flow that happens now, the start of the project. Okay, but this amount here is not going to be affected. It doesn't have to be adjusted. These have to be adjusted. Okay, so and this basically says the same thing. The cash inflow of the second year is $4,000. Well, $4,000 in 2 years, okay, and $4,000 today are different amounts because of time. So we need to adjust them. Okay. Well, let us and the adjustment basically is to pull these future amounts back to the present, basically, through an equation that we're going to talk about. So the technical term for it is we're going to calculate the present value of these future amounts. Okay, these amounts are in the future. We want to find out what they are in the present. So these are the present values, okay, of these future cash flows. Okay, also known as this is just more context, today's value of these future amounts. Okay, in order to really understand what the present value of a future amount, or what the future value of a present amount is, let's look at this very simple example. We assume that you deposit $100 in a savings account. You check back 1 year later and, well, you see $110. Now this means that a $10 interest has effectively been paid to your account. So you may want to use this to calculate the interest rate that was applied. Okay, so that interest rate is simply going to be the interest paid, so $10, divided by the principal, which is the original amount, $100. Okay, so based on that, we can see that there is a 10% interest rate that was paid. Okay, so that annual rate of 10% means that $100 today is equivalent to $110 in 1 year because of this interest rate. So if we know the amount today, and that's the present value, and if we also know the interest rate, we can use these two values to calculate the future value. So this is the amount today, $100, and in order to know the amount future value FV in 1 year, to that present value, we add the interest rate, which is the original amount times the interest rate, so 100 times 0.1. Alright, so let's try to write it in a more condensed form. So this is going to be future value is equal to present value 1 plus the interest rate, and this is how we find that future value. Okay, alright, so this is the general formula for it. FV, once again, future value is equal to present value 1 plus I. Now be careful, I is an interest rate in decimal form, not in percentage form. So instead of 2%, I would be, instead of 2, I would be 0.02. Okay, what if we want to calculate the future value in 2 years? How are we going to go about it? We already know what the future value is going to be in 1 year. This is what it's going to be. So in order to calculate the future value in 2 years, this amount, okay, since the amount is assumed to still be in the savings account, well, to this amount will be added 10% of itself. Okay, so you have the amount after 1 year, and then we add 10%. Right. So in a more condensed way of writing it would be to add a square to the 1 plus the interest rate here. So the amount in 2 years, the future value in 2 years is $121. In the same way, the future value in 3 years will be 133, because you will use you will raise whatever is in the parentheses to the power 3. Okay. So we can write a more general formula for n years if you want to find out what the future value of a present amount, okay, a present value in n years. It's going to be present value times 1 plus I raised to the nth power. So this term here, 1 plus I raised to the 10th power, is known as the compound factor. So using a present value in order to compute a future value is known as compounding. Okay, compounding is from the present to the future, just as we're doing using this formula. So the same formula can be used to calculate the present value. So we just rearrange some terms. If we do, then the present value is then equal to the future value times 1 over 1 plus I raised to the nth power. So the process of taking a future value and bringing it back to the present is known as discounting. Okay, and this term here is called the discount factor. The discount factor. All right, so now we'll go back to our project, the project for which we were conducting the feasibility study. And the present value is really what we are interested in. Remember, we had some future values in year 1, year 2, year 3, and year 4. And we were interested in bringing these values back to the present in order to conduct our feasibility study. Okay, so this is what we are going to do now. So let's use the correct methodology instead of just summing up and subtracting values. Okay, we need to discount the future values. All right, so let's assume that the interest rate, okay, that we use for this project is 7%, and the interest rate is going to stay the same throughout the project's life cycle. So because the initial investment is $10,000, it's considered as, money that is spent today. So the value of $100 today is the same today. It's $100. So this is not going to be affected, but the value of, the cash outflow in 1 year, which is 2,000, has to be discounted. Okay, so times 1 over 1 plus 0.07. Okay, So $2,000 in 1 year, given an interest rate of 7%, is equivalent to 1,869 1,869 and a few cents, as you can see. All right. So this is the amount that we need to use when conducting our feasibility study. Well, our first cash inflow that occurs in 2 years, a cash inflow of 4,000, needs to be discounted. So notice that now the discount factor has an exponent of 2 here. Okay. So $4,000 in 2 years, that's equivalent to 3,493 and a few cents. 7,000 in 1 year, in 3 years, I'm sorry, is equivalent to this amount today, and $3,000 in 4 years is equivalent to this amount today. All right. So these are the values that we will use for our feasibility study. All right. So what are the cash outflows? These are the cash outflows. So this is the initial cash outflow, and this is the cash outflow in year 1. So we have a total cash outflow of 11,869. And this is the sum of all the present values of our cash inflows. So we have 11,496,000. So when we subtract the cash outflows from the cash inflows, we obtain a negative value. This is known as the net present value because it is the sum of the present values of all cash flows in the project. So it's known as the net present value. And because our net present value is negative, we conclude that this project is not viable, which is a very different answer from the answer we got when we were just summing up the values and subtracting them. Okay, now that we understand the concept of the time value of money, future value, present value, and how we use interest rates to calculate them, let's talk about the credit market and interest rates. Well, the concept of the present value of money and the future value is very important in the financial world, especially in the credit market. Well, it's important because when we talk about the credit market, by definition, it involves streams of cash flows, and the cash flows are going to be in the future, right? So when you take a loan today, you will have to pay back in the future. So time is going to have an impact on the amount that you will have to pay back. Therefore, the time value of money has to be accounted for. So computing the present value of these future cash flows is important in order to evaluate debt instruments. So let's talk about 3 debt instruments. In other words, let's talk about 3 types of credit that can be given to a person or a business or the government. Let's talk about 3 of them and how the time value of money affects them and how to calculate the present value of these debt instruments. We'll start with simple loans. Well, this is the simplest form of debt. This is actually the type of debt that we used earlier with the savings account example. So what is this form of debt about? The lender provides funds to the borrower who has to pay back. So the payment is actually a single payment, which includes the original amount called the principal, so the amount that was borrowed, plus a predetermined interest at maturity. And by maturity, we mean the date when the debt must be fully paid. That's what we call the maturity of a debt instrument. Okay, so that's really simple. So let's use this example to kind of illustrate how to calculate the present value for this type of loan. You take a loan of $5,000 from the bank, okay, with an annual interest of 8.5%. The maturity date for the loan is 5 years from the day you take that loan. How much will you have to pay back in 5 years? Okay, so this is fairly simple. How much you will have to pay back in 5 years is basically trying to calculate the future value. You know how much money you take today. You know what the interest rate is. You can use these 2 values to compute the future values. Okay, this is the formula that we learned earlier. Future value is equal to present value times 1 plus I raised to the nth power. Okay, and when you plug in the different values there, this is how much you will have to pay in 5 years. $7,518 with a few cents. Okay, that's how you calculate the future value. A second example, okay, this is slightly different. Your friend gives you a loan of $250, and that friend demands that you pay back $450 in 5 years. Okay, 250 today, and in 5 years you have to pay back 450. Knowing that the interest rate is 11%, is this loan a good deal for you or for your friend? Now, it's important to understand why the interest rate is given here. It means that if you were to take a loan of $250 at the bank, the interest rate that would be applied to it would be 11%. So what you want to do is then find out if taking a loan from your friend is the best choice, or maybe go to the bank instead to do that. Well, there are two ways to compute this question. The reason why there are two ways is because we have a present value, that's the amount that you are borrowing today, but you also have the future value, and that's the amount that you have to pay back in 5 years. Okay, so let's use each of them to find out if this is a good deal for you or for your friend. Now, let's compute the future value of the loan and compare it to $450. That's the first solution. So you're going to take $250 today, and knowing that the interest rate is 11%, in 5 years, at a rate of 11%, the future value is $421. So this is what you should be paying back. But the friend demands that you pay back $450. So you see that this deal is actually in your friend's favor and not in yours. So it's actually better to go to the bank and take the loan from there, because you will end up paying back less money. The second solution is, well, we know that $450 will be paid back in 5 years. So what we can do is we can use this future value and discount it to the present. Find out what it is worth today. When we do that, again, using 11% in 5 years, we realize that, well, $450 that we are meant to pay back in 5 years are actually worth $267 today. Meanwhile, we are only borrowing $250. Okay, so basically, this is another way to show that this deal is good for your friend and not for you, because you would only be paying back $450 in 5 years if you were borrowing $267 and not $250. So that's a bad deal for you once again. Okay, so simple loans, as the name implies, they are very simple. This is how you compute future values and present values with that kind of debt instrument. Let's talk about fixed payment loans. That's a second form of debt instrument. So it's a form of debt which requires the borrower to pay back the lender with equal installments at regular intervals during a certain time period. This is something that is actually very, very popular. If you want to purchase an expensive piece of equipment, maybe expensive furniture, or you need a laptop, and you can actually purchase that laptop as a fixed payment loan, in the sense that you will pay back the store with equal installments. Now, each installment that the borrower pays has two components. Each installment has, one of the components of each installment is the principal, and also a fraction of the interest that you are going to end up paying. Because, of course, as a loan, if you calculate the true value of all the installments that you're going to end up paying to the store, is going to be much more than the actual value of the product that you purchased. Okay, so each installment, once again, has part of it is the principal, and part of it is a fraction of the interest. So two popular examples, I think I just gave. Oh no, sorry, I didn't talk about that. Okay, auto loans and mortgages. Okay, but again, many stores offer some facilities to purchase their products. But auto loans and mortgages are very popular examples of fixed payment loans. Okay, so how do you then compute the present value of a fixed payment loan? Remember, you are going to have to pay installments over time. And because the installments are going to be paid over time, the time value of money has to be taken into account here. So each installment, so I mean, for this example, we assume that each installment is made annually. And if the installments are made annually, this cash flow is the cash flow you pay in 1 year. Well, you have to discount it. Oops, sorry. You will have to discount it. This is the second cash flow that is paid, or the second installment that is paid in the second year. You have to discount it, and then discount the third installment all the way to the nth installment. And all these discounted cash flows need to be summed up in order to know the actual value of what you're paying, the present value of what you're actually paying. Okay, this is how to do it. So you can't just sum everything up, which is what many of you, I suspect, have done. I mean, if you've ever taken a fixed payment loan, what most people would do is, okay, since I have to pay $700 per year for 10 years, well, I'm just going to sum everything up. So that's 700 times 10, and that's 7,000 I'm going to pay back. Yes, it is in nominal form, but it is not the present value of what you're actually paying. Let's look at this example here. Eva is a first-year student in the Department of Graphic Design. She just realized that she needs a laptop for all her graphic design work. But the laptop that she needs is beyond her budget. It's a pretty, sophisticated laptop. It's $1,200. So what she resorts to doing is, taking the computer on credit as a fixed payment loan. And the facility that is given to her is that she will pay $400 every year for the next 5 years. So if the going interest rate is 12%, we want to find out what is she really going to be paying in today's terms for the laptop. All right, so this is the cash flow in the first year, $400, and discounted with an interest rate of 12%. And this is the discounted value or the present value of the second installment, third installment, fourth installment, fifth installment. And when you sum everything up, well, basically what she ends up paying is $1,441. And I'm sorry, guys, this is a typo. It's supposed to be the present value and not the future value. But this is PV instead of FV. Sorry about that. Okay, so now this is a practice question for you. Based on this result, determine how much total interest Eva will pay. So can you calculate it? How much is the principal component in each installment? And how much is the interest component in each installment? Can you do that? So I'm going to leave this to you to do. Okay, now we've talked about simple loans. We've talked about fixed payment loans. It is now time to talk about coupon bonds. Coupon bonds, okay, or bonds short, are a very important debt instrument for the entire economy. And the reason why coupon bonds are very important is because they represent huge volumes of funds. We're talking about trillions of dollars. So they are really important. So many corporations raise money through coupon bonds. Okay, many of them actually do not just take loans from the bank for their operations. They raise money using coupon bonds, and we'll talk about what bonds are in a second. And the government as well, the Federal Reserve, they use bonds in order to conduct monetary policy. So that's what we call open market operations. Okay, so we have open market purchases and open market sales. Open market purchases, that's when the Fed, okay, when they buy bonds in order to increase the money supply, and open market sales is when they sell bonds in order to decrease the money supply. So these debt instruments, okay, represent so much money that they represent a good way to decrease and increase the volume of money in the entire economy. So can you imagine? Okay, that's how much money these debt instruments represent overall. The issuer of a bond is the borrower, and the buyer of a bond is the lender. So when a company needs money, what they do in order to raise funds is to issue bonds or sell bonds. And people that have excess money can buy the bonds, and this is actually how they borrow it. So a coupon, and we said, a coupon bond is a debt instrument. It has a face value, and what we call the face value is the amount that is borrowed when the bond is issued. And this amount is actually written on the bond, which is essentially a piece of paper, right? The bond issuer, which is the borrower, must make frequent payments at regular intervals until the maturity date. The maturity date here is the date of last payment. And these frequent payments are also known as coupon payments, and they are a percentage of the coupon's face value. Now, coupon payments, okay, those regular payments are they exclusively represent interest payment on the loan. Now, this is different from fixed payment loans because we said that each installment had a principal component and an interest component. But in the case of coupon bonds, all the payments that are made are exclusively interest. Okay. And when the bond reaches maturity, there are two last payments to be made. You have the last coupon payment, and then you also have the face value of the bond that is reimbursed fully. So this is when the principal is actually reimbursed. Okay, that's when the bond reaches maturity. So how do we calculate the present value of a coupon bond? How do we know how much we are exactly paying when we borrow money from using the coupon bond market? Well, C here stands for coupon payment. So these are all the coupon payments that you make annually, for example, for n years. But in the nth year, as you can see, the last coupon payment has to be made. Also, the face value of the bond has to be reimbursed. And each of these coupon payments has to be discounted. In other words, they have to be pulled back into the present in order for us to know how much they really represent today, even though these payments are going to be made in the future. Let's use an example. What is the price of a bond? And by price of a bond, we also mean what is the present value of a bond. Okay, so what is the price of a bond with a face value of $22,000 and a coupon rate of 10%? The bond's maturity date is in 5 years and the interest rate is 6%. Now, it's important to understand that the coupon rate is the percentage of the face value that is paid at regular intervals. This is what makes the coupon payments. All right, so the coupon payments are going to be $2,200 for this coupon bond, for this bond. But the interest rate here is different. This interest rate represents the interest rate that we need to use in order to discount the future values, the future cash flows. That's the main difference. Okay, so let's go ahead. So we just said it, the coupon payments are going to be $2,200, and this is us discounting the coupon payments for the next 5 years, and in the 5th year a second payment of $22,000 is made, so we have to discount this last payment as well. So when we sum up all these values, we obtain the present value of the bond, which is also known as the price of the bond. It is $25,706. So when this amount of money is borrowed, so how much was borrowed when the coupon was issued? $22,000. But how much, okay, is going to be paid back when the bond is fully paid? $25,000. All right, so we have some level of interest on top of the original amount, also known as the principal borrowed. Okay, so it's a good deal for the buyer, of course, because the buyer is the lender. So of course there's going to be some sort of interest that the buyer is going to gain, or else it wouldn't be a good investment to buy a bond if this here wasn't the case. Okay, now this, what we've discussed so far is the traditional type of bonds, but you also have other types of bonds. You have zero coupon bonds. What is a zero coupon bond? It's a bond that pays no coupon, so the coupon rate is essentially 0%, and it is sold at a discount. When a bond that is sold at a discount is a bond um, for which the purchase price is less than the face value. In other words, um, the amount of money that was borrowed when the bond was issued is less than the face value written on the bond. So this is called a discount bond actually, and we're going to talk more about discount bonds here. And the face value, of course, is reimbursed at maturity with no coupon payment made in the middle. So a discount bond is again a bond that is sold at a discount. The amount of money borrowed when the bond is issued is less than the amount of money, the face value that is written on the bond. The face value is reimbursed at maturity as well, but unlike the zero coupon bond, coupon payments are made by the issuer of the coupon bond. Okay. So we just talked about three debt instruments and how the concept of the time value of money is applied to them, especially to determine the present value of these debt instruments. We talked about simple loans, fixed payment loans, also coupon bonds. Well, as I told you, coupon bonds are very important for the economy. This is why we're going to spend a lot more time with coupon bonds. Actually, we'll be talking about bonds for the rest of this chapter, as well as the next chapter, chapter 3, which is going to be on the behavior of interest rates. So for now, let's talk about the relationship between bond prices, coupon rates, and the yield to maturity. So what's on a coupon bond then? Okay, so we have the name of the issuer, okay, the name of the entity that borrows money through that bond, the face value of the bond, so how much money is borrowed, when the bond is issued, the coupon payment or the coupon rate. So this tells you how much every regular payment is going to be, known as the coupon payment, and also the maturity. How long is it going to take for the bond to be fully repaid? Okay, let's talk about the relationship between the yield to maturity and the coupon rate. Well, the yield to maturity is nothing new. Actually, the interest rate is also known as the yield to maturity. This is especially used in the context of bonds. In the context of loans, simple loans, well, the interest rate can also be called the yield to maturity, but this term is really used a lot more when we talk about the bond market. So this is different from the coupon rate. Okay, this is something that I mentioned before, and that coupon rate is the percentage of the face value that you have to pay at regular intervals. So the yield to maturity and the coupon rate are different. Now, once again, let's take a look at the formula for the price of a bond, or the present value. So these are the discounted values of all the coupon payments, okay, for all the n periods. And then this is the face value of the bond. And FV also stands for future value. Well, it's really convenient because that face value is paid in the future. So it's also a future value, right? And this is also discounted. So let's now use this formula in order to study the relationship between the coupon rate and the yield to maturity. Well, what happens if the coupon rate is equal to the yield to maturity? Let me go back. What happens if I is equal to the percentage that C represents in the face value? Okay, what happens? We're going to use an example for that. Calculate the price of a 10% coupon rate bond with a face value of $8,000 and a maturity of 6 years. The yield to maturity is 10%. Compare the bond price to the face value. Okay. All right, so when we do that, that's 800. These are the coupon payments because the coupon rate is 10%. And also the yield to maturity is 10%. We have the face value here. We realize that the present value, which is the price of the bond, is equal to the face value. All right, so what did we just learn? When the coupon rate is equal to the yield to maturity, then the price of the bond or the face value, the price of the bond or the present value is equal to the face value of the bond. Okay, case number 2. What happens if the coupon rate is less than the yield to maturity? Well, this time we assume that the yield to maturity is no longer 10% like the coupon rate, but it increases to 12%. So what happens? What's the new bond price in the case? In that case, okay, when we do that, we realize that the bond price is now lower. It's less than 8,000. It's now 7,851 and some cents. So in the case where the coupon rate is less than the yield to maturity, well, the bond price is less than the face value. Case number 3, when the coupon rate is greater than the yield to maturity, well, now let's assume that the yield to maturity is no longer 12%, it is now 8%. And what happens to the bond price? Well, when we do that and we apply the same formula, and now you see that the yield to maturity is 8%, we see that the present value of the bond is now higher than the face value of the bond. Okay, so this is a sort of summary of what we just said about the relationship between the face value and the present value, given that the coupon rate is higher, lower, or equal to the yield to maturity. So when the yield to maturity is equal to the coupon rate, the bond's price is equal to the face value. When the yield to maturity is less than the coupon rate, well, the bond price is higher than the face value. In the same way, when the yield to maturity is higher than the coupon rate, the bond price is less than the face value. But there's also a very important thing that we learn, and that's that the yield to maturity and the bond price have an inverse relationship. This means that when the yield to maturity increases, the bond price decreases. And when the yield to maturity decreases, the bond price increases. So we can actually, I'm going back, we can actually take a look at the formula for the price of a bond. And this is the yield to maturity. Now you can see that the yield to maturity is actually in the formula, it's in the denominator of every component of the formula. And because it is in the denominator, when it goes up, then the overall value has to go down. And of course, when it goes down, the overall value has to go up. So there's this inverse relationship between the yield to maturity and the price of a bond. Now, let me try to explain this to you with a little bit of intuition. Remember that the yield to maturity represents how fast the value of money goes down. Okay, how fast the value of money goes down. So if the yield to maturity increases, it means that the value of money goes down quickly. And that's bad for the value of the bond. Okay, and the present value of the bond, that's bad for it. All right, so if the yield to maturity increases, this will have a negative impact on the present value. But if it decreases, it will have a positive impact because the value of the bond is not going to fall too fast, basically. Now, looking at when we compare the coupon rates to the yield to maturity, is the same. You can see the coupon rate as the good rate for the investor, because remember, that's how much money the investor is going to be receiving at regular intervals. So the coupon rate is the good rate because if that rate is bigger, then the investor receives a lot more money. But if the yield to maturity is bigger, well, that's bad, right? So when we compare these, if the coupon rate, the good rate, is greater than the yield to maturity, which is the bad rate, well, it makes sense that the value of the bond will be higher than the face value. But if the coupon rate, the good rate, is less than the yield to maturity, the bad rate, well, then the present value of the bond will be less than the face value of the bond. So this is how to explain this from an intuition perspective. So now we're going to talk about changes in interest rates, bond price fluctuations, and secondary bond markets. When a bond is first issued, by an entity as a way to raise money, we say that the bond is issued in the primary market. And during the transaction, the amount of money given by the bond buyer is the face value on the bond. Okay, that's the amount of money which is borrowed by the issuer of the bond. But it is also possible to sell a bond in the secondary market. Well, what this means is that the bondholder is actually selling that bond after holding it for some time. And of course, while holding the bond, that bondholder received a few coupon payments in the process. Okay, so this is, if you want, a pre-owned bond. That's what a bond sold in the secondary market is. So why would someone invest in a bond and receive coupon payments and all that and then decide to sell it to someone else? Well, there may be many reasons for that. But the main reason for selling a bond is that the price of the bond changes over time. Now, this is directly related to what we just, discussed about the relationship that exists between the yields to maturity and the price of the bond. Now, the yield to maturity or interest rates is a variable that fluctuates all the time. And this is actually going to be the topic of the next chapter. What causes the yield to maturity to change over time? What causes interest rates to change? Okay. All right. So, for example, an investor may purchase a bond for $10,000 and may be willing to sell it for a profit a few years later if the bond price increases to $12,000, for example. So that investor would be making some sort of profit. The price of a bond will change primarily due to changes in the yield to maturity, like I just said. Once again, this is the formula for the price of a bond, or the present value. The interest rate is the denominator. This is the reason why there is an inverse relationship between the yield to maturity and the price of the bond. So when the yield to maturity goes up, the price goes down. When the yield to maturity goes down, the price goes up. So there's that inverse relationship or negative relationship between the price and the yield to maturity. So fluctuations in interest rates in the economy are the main reasons why bond prices change. When the yield to maturity increases, bondholders are willing to sell them in the secondary market due to the decreasing value, right? Because if you're holding an asset whose value is going down, then you want to get rid of it. So this might be a reason why the holder of a bond may want to sell it in a secondary market. When the yield to maturity decreases, okay, well, bondholders are willing to keep them in the secondary market due to the increasing value, right? So they are just willing to keep them, and not sell them, basically, because now they hold an asset that is increasing in value, even though some people may want to, just get some profit by selling it. Okay, it's actually very possible too. Okay, now let's talk about the difference between interest rates and rates of return. Now, the rate of return is the benefit earned by any entity for holding a financial asset. That's what the rate of return is. In many cases, it is possible to use the two terms interchangeably, rate of return, yield to maturity, or interest rate. So it's very, very possible and correct to use them interchangeably in many cases. But it's not always the case, actually, that they are the same. More formally, the rate of return for holding an asset is equal to the sum of, number one, the payment received for holding the asset, and number two, the difference between the current price and the asset and its purchase price. And all this expressed as a percentage of the asset's purchase price. What does this mean? Let me give you an example. Let's assume that you have a hen. You purchase a hen, and it turns out that this hen lays golden eggs. Okay. Well, you purchase the hen for a certain price, and that hen is your financial asset, your financial investment. Well, if you want to find out the rate of return on purchasing that hen, it's going to be equal to, well, number one, we said the payments received for holding the asset. So in that case, it will be the value of the golden eggs laid by the hen. So what that asset produces that is of value to you, that's the first element of the rate of return. But the second element that needs to be added as well is the difference between the current price and the purchase price. In other words, if you purchase the hen for $500 and now the hen is, the value of the hen is $600, that increase in the value of the hen, besides the golden eggs, that increase in the value of the hen has to be accounted for, has to be also included when computing the rate of return. Okay, so this is in simple terms what the rate of return is. Let's use a very simple example to illustrate it. Let's calculate the rate of return on a simple loan. We already know what simple loans are. A loan of $250 is given to an individual with a yield to maturity of 10% for 1 year. So we can calculate the future value in a year, right? 250 times 1 plus 0.1, and that's $275. Okay, fairly easy so far. So the refund amount is made up of two components. The first component is the principal. So inside the 275, 250 is the amount of money that is borrowed, and then we also have the interest payment, which is $25. So in this case, the principal after 1 year is the same. So the value of the financial asset, which the loan represents here, is the same. And only the interest comes as an added value. But the principal itself has no change. So the change is equal to 0. But we can calculate the rate of return. So this is the payments received for, if you are the person who gave the loan, for example. This is the payment received because you gave the loan, because you hold that financial asset. And this is the change in the price of the asset, which is 0. Okay, and all this as a percentage of the purchase price, which is 250, and this is the rate of return, 10%. So in the case of a simple loan, the rate of return is equal to the yield to maturity. So I said earlier that, well, the two terms can be used interchangeably in many cases, but it's not always true that they are the same. Let's look at another example. Let's look at the rate of return on this coupon bond. So a 10% coupon rate bond with a face value of $25,000 has a maturity of 25 years. The yield to maturity is 12%, so that's the interest rate. An investor purchases the bond in the primary market, holds it for 1 year, and then sells it in the secondary market for $26,000. So what we want to do is we want to calculate the rate of return on holding that asset, that bond, for 1 year. Okay, so the investor receives one coupon payment. So this is the benefit of holding that asset for 1 year. And the coupon payment is going to be $2,500. So this is received. Okay. Now let's see the change in the bond's value once again. So the purchase price of the bond was $25,000, but he was able to sell that bond for $26,000. So we have an increase in the bond's value to the bondholder of $1,000. So in this case, we can calculate the rate of return. This is the benefit received for holding the bond, aka the coupon rate. This is the increase in the value of the bond after 1 year of holding it. All this as a percentage of the purchase price of the bond. And you can see that the rate of return is 14%. Remember that in the question, we said that the yield to maturity or interest rate was 12%, but in this case, it is different from the rate of return, which is 14%. Okay, so more generally, this is how you would calculate the rate of return. It would be for a bond especially. Okay, it would be the coupon payment that you receive plus the change in the price of the bond. So PT is the price of the bond at T1 at time T, and PT plus 1 is the price of the bond at T plus 1. And this difference is basically the change in the price of the bond. Of course, also all this as a percentage of the purchase price of the bond. Now, it's possible to break up this fraction into components. So we have C over PT, and then PT plus 1 minus PT over PT. Okay, these two terms actually have names in the world of finance. This is known as the current yield. Okay, this is the coupon rate divided by the price of the bond. So this is the current yield. All right. And this is the rate of capital gain. So this is the percent increase in the price of the bond. Okay, now that we've talked about changes in interest rates and how they affect the bond, let's talk about bond maturity and the volatility of returns. So we learned earlier, by the way, this is the past form of to learn in written in British English. Okay, so we learned earlier that bond prices are affected by changes in the yield to maturity. Okay, there's an inverse relationship, and that inverse relationship, we talked about it. When the yield to maturity goes up, the price of the bond goes down, and vice versa. But then the degree of change in the bond's price due to a change in the yield to maturity depends on the bond's maturity, okay, or depends on how far we are from the bond's maturity date. So we're going to use an example to illustrate this in order to make it more understandable. So it means that when the yield to maturity changes from, let's say, 7% to 8%, well, that's an increase. So we expect the price of the bond to decrease, right? The change in the bond's price with the time to maturity of 3 years, okay, is different from the change in the bond's price with the time to maturity of 15 years. So the time that you have left before the maturity of a bond determines how sensitive the bond price is to changes in the yield to maturity. All right, so we're going to use a few bonds in order to illustrate this. Let's consider a bond that has a coupon rate of 10%. The face value is $1,000, and then there's an increase in the yield to maturity from 10% to 20%. Okay, so we're going to apply this increase in the yield to maturity to all these bonds that we're going to look at right now. The bond price when the yield to maturity is 10%. So that's what we want to compute. Okay, we want to find it out. And then we want to find out what is the new price when the yield to maturity changes to 20%. Well, in this case, we're going to have several bonds with different yield to maturity, with different times to maturity, and some of them can be long. So using a calculator to do it manually is going to take some time. So it might be better to use either a financial calculator, and on the slide, this is a link to a website that has a calculator that you can use to obtain the values that we're going to see in the next slides. And we also need to compute the rate of capital gain. Remember, this is the percent change in the price of the bond, and this is the rate of return. Okay, the rate of return is the rate of capital gain plus the current yield, which we will have to compute as well. Okay, so these are the 4 bonds that we are going to consider for this small exercise. So these are the bond IDs, bond 1, 2, 3, and 4. And bond 1 has a very long time to maturity, 30 years, 20 years, 10 years, and 5 years for bond 4. And the current yield is 10% for all of them right now. So that's if you want the coupon rate at the moment, okay? And the face value of these bonds is $1,000. Okay, and the bond price when the yield to maturity is 10% is also $1,000. Well, this makes sense because remember, when the yield to maturity is equal to the coupon rate, okay, then the price of the bond is equal to the face value of the bond. So it is $1,000 for all of them right now. Okay, now the bond price, the yield to maturity is going to increase from 10% to 20%. So what we are going to do now is to compute the new price using a financial calculator on application online. We're going to compute the new bond price now that we have a higher yield to maturity. Okay. Well, for the bond price with the time to maturity of 30 years, the new price is 502, then 513 for the maturity of 20 years, 10 years 580, and 5 years $700. Okay. So you see that, the features of all these bonds are almost equal. Okay, so all these bonds are almost similar except for how long it will take to pay off the bond completely. And as you can see, the impact on the price of the bond with a higher maturity is much higher. I mean, the fall is much bigger because we are going down from $1,000 to 502. So that's a much bigger fall than the bond fall, which has a time to maturity of 5 years. And the fall is only from $1,000 to $700. So based on this only, we can tell that changes in the yield to maturity will have a bigger impact on bonds with a longer time to maturity. And it goes in both ways. In this case, the yield to maturity increased from 10% to 20%. But if there was a decrease in the yield to maturity, then the price of this bond, that has the longest time to maturity, will be much more, drastic than everything else. All right, so let's look at the rate of capital gain. In this case, that would be a rate of capital loss, okay, because the value of the capital product here is going down. So we have negative 49%, negative 48%, negative 42, and then negative 30. And of course, the rate of return here is negative because the value is going down. The value or the price of the bonds, the prices of the bonds are going down, so the rates of return are negative as well. Okay. All right, so this is essentially what I just explained, but we need to remember that changes in the yield to maturity have a more significant impact on bonds with longer maturity. That's really what we need to remember. And this leads us to what is known as the interest rate risk. Okay, so investing in bonds with longer maturity is a double-edged sword. Why? If the yield to maturity goes up, the loss of capital can be significant. But at the same time, if the yield to maturity goes down, then the capital gains can also be large. This is known as the interest rate risk. In the bond market, just like in the world of finance in general, there is a trade-off between risk and returns. So if you go for bonds with a longer maturity, that's a high risk, but then you get high returns as well. If you go for bonds of shorter maturities, well, that's a low risk, and then you get low returns as well. Okay, now let's talk about real versus nominal interest rates. There is an economic phenomenon known as the inflation, rate, or known as inflation, which is the persistent increase in overall prices over time. One thing that inflation does is that it decreases the purchasing power of money because it causes goods and services to become more expensive. Okay, so when prices are higher, you cannot buy as much as you used to, so your purchasing power has gone down. So our discussion on interest rates so far has been focused on nominal interest rates. And what do we mean by nominal interest rate? An interest rate is said to be nominal when it does not account for the effect of the inflation rate. So in our discussion of interest rates so far, we haven't really mentioned anything about the inflation rate. So this means that these rates were indeed nominal rates. Okay. So how do we then account for inflation in interest rates? Let's use this example. If we assume that we open a savings account with an interest rate of 7%, well, it means that the deposited amount is going to grow at a rate of 7% every year. But the thing is, the inflation rate will also have a negative impact. Okay, so this rate here, 7%, is going to make your money go up. But then if we assume that the inflation rate is 3%, it means that money that amount of money in the saving account is going to lose its purchasing power by 3% annually. So 7% up, 3% down. That difference, the difference, and sorry for the typo here, between the nominal rate and inflation rate is known as the real interest rate. So your money is not really growing at 7%. That's the nominal interest rate. It is actually really growing at a rate equal to the difference between the nominal interest rate and the inflation rate. Okay, and this is the formula for the real interest rate here. Okay, and of course this would be 4%. Okay, 7% minus 3%, that would be 4%. All right, this is the end of this fairly long chapter, the meaning of interest rates. And you should now be able to understand the concept of the time value of money. Should be able to compute present values and future values given the necessary amounts and the interest rate and the number of years. You should be able to do that. Should be able to determine whether a project is viable or not based on all the project's cash flows. You should understand the three debt instruments taught in this chapter. You should at least understand how they work and compute their present value. Simple loans, fixed payment loans, and coupon bonds. Should be able to compute the present value, as I said, of each of these debt instruments, determine whether a coupon bond is profitable or not based on how the coupon rate compares to the yield to maturity. Should be able to understand the relationship between bond prices and the yield to maturity, understand the interest rate risk, and also understand the difference between the nominal and the real interest rate. So there are some practice questions at the end of this chapter, but I am also uploading a separate file with these practice questions, and I'm also uploading the solutions to these. So thank you very much for watching it to the end, and let me know if you have any questions. Thank you.